Good morning, good afternoon, good evening, however I might find you today. Welcome to another opportunity for you to learn about what we call the wheel strategy. Now, this is still stock options that we're discussing today, but we're specifically talking about a strategy that is called the wheel strategy. And once I get into it, you'll understand why we call it the wheel strategy. So let's get into it. So, what is the wheel strategy, Mr. Ray? Talk to us about it. Well, the wheel strategy consists of three distinct pieces. The first piece is you sell a put. And when we say sell a put, that means that you are selling to a buyer on the other side who is buying the put. Now, the second part of that wheel is if for some reason the stock goes below where you have the strike price, and you will get assigned that stock. Okay. And then we have what we call, after you get an assignment, you will sell a call on that. And then you just simply rinse and repeat. And therein lies the wheel, baby. We're talking about the wheel. So first you sell a cash secured put. And this is where you get paid, baby. We always got to get paid. And so we get paid when we agree to purchase this cash secured put that we already want. This is mostly a stock that we already want, and it's a price that we're willing to pay for it. So when we set the price on this, this is a price that we're willing to pay. Now, if for some reason that strike price goes below the put price, then we're going to be assigned that stock. That is, we got to buy that stock. All right, that's part of the contract. But we're buying the stock at a discount because we've already collected a premium, and so we get to deduct the cost of that premium from the cost of that stock. And then lastly, if we do get assigned that stock because it went below the strike price, then we're going to turn right around and sell a covered call. And we're going to get paid again, right? We already got paid when we sold the cash secured put. Now we're going to get paid again when we get assigned, when we sell what we call a covered call. So let's look at this thing. Why do we call it a cycle? It is a wheel. First, we're selling the secured put. Again, we're collecting a premium when we buy it. If for some reason the stock falls below our contract price, which is our strike price, we simply get assigned that stock and we have to pay for that stock. Now we own shares of that stock. But now that we own the shares of the stock, we can turn right around and sell what we call a covered call. Since we own the stock is our cover, and we will sell a call on that, and we will again earn more premium. Now, if the stock gets called away at our covered call strike price, we're going to turn around and use that same money and do it all over again, baby. We're just going to rinse and repeat. Therein is the wheel cycle, baby. So let's look at an example here to give you an example of what we're talking about. Let's say you have a stock and it's trading right now at $52. And you think this is a very good stock, and you're saying, I'm willing to purchase that stock for $50. So you would sell a put for $50 and you'll get paid a $1.50 premium for that put. So what that means is you will have to have at least $5,000 available to buy that stock if in fact it goes below the strike price. So if the price, it's the stock of the price, it's the price of the stock is $50, you got to make sure you got $5,000 in your account in case you get assigned. But in the meantime, if you don't get assigned, you're going to get that $150 right up front. Okay. So let's say the stock drops to 49. All right. You still got to buy it at 50 because that's the price that you agreed to buy it at, right? Okay. So the cost basis is $50 less the $1.50 premium that you already got paid. So now the cost of those shares was actually $48.50. Now you were okay with owning it at $50. So now you're owning it at a discount. So now you got the stock. You're going to turn around now and you're going to sell a call. Now, let's say the stock recovers to, let's say, $50 because remember, it went below and now you got to sign it. So now you sold a call for $52. Okay, you collected a premium of $1 for selling that call. Now, in effect, your new effective cost is at $48.50 less the dollar that you received. Now the cost is $47.50. But remember, you've now collected $250 premium. You collected $100 when you sold the call, and you collected $150 when you sold the put. So what's the result? If it get called away at $52, the stock price was $200. What? You got $50 and $52 times 100, $250, baby. And all you had to do was put up the 5,000. And so the return on your 5,000 over that 60-day, let's say it was a 60-day period, is 9%. That's pretty good return, baby. Tell me any stock or any other asset class out there that's returning 9% over 60 days. Come on, somebody. So who is the wheel for? Now, who does this really make sense for? Well, first of all, the will is for you if you want to make consistent income and you're not really to look to do the home run, baby. You're not trying to knock it out of the park. You're just trying to get base hits. It's also for you if you're patient, if you're okay with slow and steady. If you're not out here trying to hit the big home run, you just want slow and steady. This is for you, baby. If you have cash, now you got to have cash to play this game, baby, because whenever you sell a put, you got to have at least that amount of money available to buy the stock in case it breaches your strike price. Uh, you want to own stocks at a discount. You're okay with owning stocks. You know, if you don't want to own stocks, this is not for you. You prefer math over emotions, right? If the numbers make sense, I always used to say, fall in love with them numbers, baby. Don't fall in love with the assets. So if you prefer strictly math, where you can earn 6 to 9% on your money, this is where you want to play it. And these are value systems, not speculation, baby. We're not speculating. Now, this might not be for you if you want to get rich quick. We're not here to get rich quick, baby. If they're selling you get rich quick, you got to go somewhere else. That's not what we're doing here. We're teaching you how to make consistent money. If you're looking at 100% gain overnight, I'm trying to double my money overnight, Mr. Ray. No, that's not what we're doing, baby. If you can't handle seeing your stock dip a little bit, now this might not be for you. If you're ready to run for the border every time your stock price go down a little bit, this is not for you. And if you don't have any capital set aside, come on, baby. You can't play this game. You're going to need some money to get in this game. If you want excitement, this is not it, baby. We're here to make money on a methodical basis. And if you're not willing to learn the basics first, come on, somebody. You're in this to learn. And once you learn it, you're going to understand that this is a great system for you, baby. It's called the wheel strategy. And why does the wheel strategy work? First of all, there's this issue that's called time decay, which each day that passes, the value of your option gets better and better. Come on, somebody. It's like over time, you are amassing more value. Okay. You get profit as the clock ticks. Secondly, you're collecting premium twice. You're collecting it one time when you sell the put, and then you're collecting it again when you sell the call. Okay. The premium, every time you get a premium, that lowers your cost basis, which is the basis for which you acquired that stock. And you get to pick the stocks, baby. There ain't nobody out there telling you what to. If you like Amazon, if you like Nvidia, if you like what are some of the other ones? There's a lot of great stocks out there. You have to pick the stock that you like. Okay, I like stocks that are of the technology range. You know, I'm looking for stocks like uh, I like Tesla. I do like Tesla. I do like all the stocks that are making money, baby. Come on, baby. If they're making money, if they're solid stocks, those are the stocks that you want to be buying. And those are the stocks that you're going to be selling puts on, okay? Because you don't mind owning them. And it's a repeatable system, baby. It's not a one time play. You buy a put, If you get assigned, then you turn around and sell a call. That's how it works, baby. And you keep every time you make a transaction, you make money. Okay? So there you go, baby. That's it in a nutshell. Cash secured puts is what we're going to be talking about next. We're going to show you the full mechanism for selling the puts. We're going to show you how to pick the right strike price, the right expiration, and what happens if you get assigned. Come on, baby. We're going on this journey. It ain't gonna cost you much. But it's gonna cost you your time and a little bit of your capital. But we know that you can do this, baby. I've done it. If I can do it, I say anybody can do it. So let's get ready for episode 3. Go back through this lesson though. Make sure you understand the wheel strategy, baby, because that's what we're gonna be executing on. Hope you guys have a great day. Love you.